to start off, can each of you guys give a little bit of a personal background and an overview on your organization?
Sure. So my name's Spencer Elliott, not Elliott Spencer, and I actually was born in Orlando, Florida, and I went to the University of Central Florida, and then ended up coming here for grad school and participated in the Masters of Entrepreneurship program here, and worked in the Innovation Hub before there was 2 buildings. I was talking to him about that earlier, and it was really cool coming back on campus today. I was in the Entrepreneurship Club and the Student Government Gator Innovators, and was running around with Dan and trying to model everything he was doing, and just had a lot of fun in Gainesville, and ended up moving back to Orlando. Started really my first larger startup that I had been a part of. I had probably worked for a dozen startups before that, just in different roles, but this was the first attempt to really, make it or break it, right? And it was called ViewStub, and we bootstrapped for 2 years. I never wanted to raise money, never wanted to take a dollar from anybody, and built the platform right into COVID. We were raising our revenues from like 5K in January that year, 2020, 10K in February, 15K in March, seeing it go up, and then COVID happened. And we were the only virtual event platform available in the marketplace at the time. It was a SaaS platform. And then a couple months later, Hopin came out, which is the fastest growing company in the history of the world ever. They raised $1 billion, went right up against us, tried to steal all of our marketing, bought 2 companies that I partnered with, just did everything to mess with me. So I learned a lifetime of entrepreneurship in a few months. It was a great experience. I still own most of that company, but I'm not involved in it. And we'll see what happens with that one moving forward. But I ended up starting a venture capital fund this year, early stage venture capital. So to everyone's point about wanting more angel investors and whatnot, future funders .vc. We really want to be the first check into the deal. We want to come in with a standard deal, so it's about $100,000 for $1 million valuation, or somewhere in that range. And we're a rolling fund, so we're constantly raising, constantly deploying. There's no specific terms or deadlines, and we accept unlimited number of non-accredited investors. But the main premise is that we're a social membership, and so, like for example, we went to a comedy show last quarter. This quarter we're doing a magic show. We've done sports simulators. We go out on the boat. We just do all kinds of fun stuff. It's really just about bringing people into the scene that have never been angel investors before or don't know anything about venture capital. And so that's why we have these social events, and we don't have a management fee. Typical management fee is where the fund will take a percentage of the assets under management. We just push it to a membership fee, so as you invest more in the fund, we don't make more money, right? So you actually have more profitability. And there's a lot of other cool stuff that we do with it, but I also just became the director for Plug and Play, Orlando Smart Cities program, and so I just started on Monday, so I can tell you guys more about that. But we have an expo tomorrow. Everyone's invited. It's at the Grand Bohemian Hotel in Orlando, and that's at 1:30 p.m. So if anyone wants to drive down, you'd be my guest. Not in a negative connotation, but you can actually be my guest. But that's a little bit about me. Thanks.
And then on the future funder side, what is usually your typical stage where you guys invest?
So we want to be the first check. So
is there a revenue threshold or?
No, it's crazy that we actually have some companies that have never taken a dollar of outside capital, but one of them has $14 million in grants. The other one has $1 million invested from the co-founders. And so those are unique, those are rare to find those types of situations. Most of the time they are pre-revenue, pre-MVP, and what we do is we put them through an accelerator. We would actually stage the investments, 25K, then you'll go through an accelerator because we believe in the Peter Thiel model, right? It's like, drop out of Stanford, create Luminar, become the youngest billionaire. We believe that, giving these good entrepreneurs money early is really the key there, and they can, cross the chasm 0 to 1 and all that kind of stuff. If they have the ability to do so. And because we're investing smaller check sizes relatively, it's a lot of money, $100,000 is a lot of money, don't get me wrong, but a traditional VC will do $1 million plus, and so we can do 10 deals for every $1 million that they do. And so we believe that we'll see more unicorns with that thesis, and our goal is to have as many deals done in Florida as possible and then grow nationally. But for right now, we're just really focused on not just any specific vertical. It's kind of to your point, is we're looking at the founders. And so, what Dan was saying really resonated. We want to find those folks that wake up and can't go to sleep without, making this work.
So if any of you guys are willing to drop out, call Spencer. Cool, TJ.
Where's Charlie Kirk?
TJ.
Nice. Yeah, so my name is TJ Fleming, not Fleming TJ, so you guys got it right?
Yeah, thank God. We had some help on the slide, so I'll make it up to you.
It's all good.
I'm messing. Let's see. So about me, I was also born in Orlando. Did not know Spencer. Grew up there my whole life. Went away to Furman University for undergrad. Majored in environmental science. Nothing to do with entrepreneurship. Liked the outdoors. Liked the people in my major. That was why I did that. But grew up a little bit entrepreneurial. I'll get back to that. But moved up to DC after undergrad, married my wife, followed her career up there, and ended up teaching middle school science and math for a few years. While I was doing that, met a pharmaceutical executive up there. There's a big biotech quarter up there outside DC. He wanted to start a vineyard and a winery, saw me, thought I could help him do that, so took that and scaled it from a little project hobby to a commercial winery over the course of 7 vintages, and so that was kind of my foray into entrepreneurship. Realized I got into the wine for the romanticism and the science, and I got out of it because it's a bad business. So wanted to kind of go back to school, do it right. Was also very interested in pursuing a commercial real estate career, so worked at a commercial real estate firm while in asset management while getting my MBA from Georgetown. Was not thinking VC at all, but was kind of simultaneously over the 5 years or so listening to a ton of podcasts, reading a bunch of books on sort of the history of different tech companies, etc., investing. And so got a chance towards the end of the MBA to launch a small venture fund focused on prop tech and construction tech in DC, kind of a hybrid of your model and a standard venture fund. And so did that for 3 years, built a concentrated portfolio of about 12 seed stage, Series A stage companies, and then have a couple kids, was looking to get back home where my family is, and who doesn't love Orlando, right?
Right.
And so was just kind of talking to people and ended up talking with the folks at Deep Work, and one thing led to another, and here I am, deploying capital for Deep Work Capital.
It's awesome.
And I can go into our strategy real fast.
Yeah, great.
So many of you know who Deep Work Capital is. I think one of our partners in biotech, Jackson Streeter, is on campus, so I imagine you've mostly all spoken to him at one point or another. So the thesis of Deep Work is very generalist, but looking to invest in underserved venture markets, so outside of Silicon Valley, outside of New York City, kind of trying to find the entrepreneurs off the beaten path that have great ideas. The founding partners are all great operators and or electrical engineers and kind of savants in their own right. Took their first fund in 2015 and have been able to return it and then some. But it's kind of, to some extent, we want to get into unicorn, but it really is about kind of standard blocking and tackling of investing and trying not to hit zeros. So Fund 1 looks like it's only going to have 3 zeros, which is great for early stage venture. So seed Series A, again, generalist focus, but with kind of a penchant towards B2B enterprise SaaS, life sciences, biotech, and kind of aerospace defense, and call it hard tech, clean tech. We will actually invest in a hardware product, believe it or not. So $1 to $3 million checks, and we'll lead rounds, but are currently co-investing, preferring to co-invest. Did I hit everything?
Yeah,
it's good. All right.
Terrell's a hustler. He's not going to let you leave this room.
All right, I got you, man.
But funny enough about your vineyard story, I went and saw one of my mentors in Napa Valley, and he said, the joke out here is if you want to make a small fortune, start with a large fortune and buy a vineyard.
Yep.
So,
That's
exactly.
all farming.
So, there's a few of you guys in the crowd that I know that want to break into ventures. So, both of you guys kind of have a more untraditional background, not going to Stanford and taking the finance route and then going working in IB and then spinning off to VC. What would you guys say is like the biggest hurdle you had to overcome? What was maybe some of your advice or kind of secrets that you guys helped break you into VC? Each of you. You can go first, or whoever.
That's mine. So again, like, until I was kind of in BC, I wasn't actually thinking of it as a career. So I think one of the pieces of advice I would give is always be networking and not taking people or conversations for granted. Because if you, paid brief attention to my story, it's like I just met these random people and started things, and then here I am, right? So, and relationships last a lifetime. They're not transactional. So whether you end up in venture or operating a business or working for a company, right? That advice pretty much is important across the board. So you never know who you're talking to and where it can lead. So kind of have an open mindset in whatever you're doing. And I went to business school thinking I'm doing commercial real estate finance. I'm going to finance a big building in San Francisco. Well, then COVID hit and I'm in commercial office and don't really want to spend any more time there. So things at your age, at your stage of your career are probably going to change. So being open to that. There are many paths into venture, as both of our backgrounds kind of attest to it. So if you can't do it in your 20s or 30s, who knows? Maybe you'll do it in your 40s and 50s.
I think what everyone was saying makes a lot of sense today, like, being able to pivot and adapt and being able to be comfortable with being uncomfortable, and that was always me. I always thought I was going to climb the corporate ladder as well, and that's why I did work for a large company for 4 years off and on, and I actually quit that company twice, which is another story for another day. But I wanted to prove to myself that I could climb the corporate ladder and that I could get my MBA and all of those things. And so when I did all of those things, I kind of was looking for the next challenge, and I realized I had always had the pull of entrepreneurship my whole life, and I was fighting it, because I thought that I needed to go this other path, and that there was another kind of predetermined, kind of journey for me, and something that I need to prove, being the first person to graduate from college in my family and those types of things. And so I was fighting entrepreneurship for a long time, and then when I got to a position where I could kind of dictate my own future, I made sure that I did it intentionally. And so one thing I do advise a lot of founders on is making sure that you're building the company to match your lifestyle, because that's going to make it to where you have the longevity, and maybe that's where the Campbell term has come from. People aren't necessarily looking for unicorns anymore, like he was saying, and there's actually a gap now from the seed round to the A round that's becoming more and more wide, and so you have to be able to survive through that period of time, and so to the survival points. But anyway, so for me, I remember very specifically writing down on a piece of paper all of the things that I was passionate about, and I had a great job. I was making 6 figures right out of college, and I was doing very well for myself, but I wasn't happy. I knew there was something more for me, and I remember one of my mentors said, like, if not now, when? What's the worst that could happen? You end up right back in the same job that you have today? Like, wouldn't that be okay? And so for me, it was all about mitigated risk and being able to say, okay, well, I could do this, right? So I put, I think it was like $5,000 aside, right? And I said, if I need this, it's there, right? And I didn't spend any of that money for 2 years. And I literally just kept telling my wife every year, I was like, if we can't turn this around in 1 year, then I'll stop, right? And then it was like, okay, well, we're doing okay. So 1 more year, okay, I'll stop, right? But it just kept going. And so I think just being persistent, to echo what they were saying, and just being very bold and not giving up on your dream, and then knocking on a million doors, right? And networking, and again, everything that everyone said is true. And for me, it was about connecting those dots on that piece of paper. And so there was 3 or 4 things that all linked together, and then I decided, okay, well, it was like, I want to go to cool events, right? And I want to be able to not have to work while I'm at the event, but I want to make money from the event. Like stuff like that, right? And like I think that there's an online streaming component to this, and so I just like tied all that together, and I built a company to match that. And then now that I'm a VC, it's because I said I want to be like Dan. You know what I mean? I want to be like Pablo. I want to like do what these guys are doing, because I had met and I met so many investors along the way. When we were raising money, that I was like, that's what I want to do. I want to be able to empower other founders. I want to be a part of their journey, and I want to be able to do it, comfortably. And so for me, I built this fund. We believe it's the most innovative fund ever, but the way that we're doing things is different. And I did that because I've been on the other side of it. I've been in the shoes of the founder, and so I wanted to build it for founders, right? And I wanted to build it for folks that are looking for that first check, because I've been through so many accelerators, and I've seen so many good companies just die on the vine, because they couldn't get $1, they couldn't get one open door, they couldn't get one investor, no matter how hard they tried or how good their idea was. And I felt like it was just because the ecosystem wasn't set up for their success, and people were leaving. That talent drain was happening in Orlando, and it's just very sad. So my goal was just to solve that, and so that's why I became a VC personally. So it was more, like I said earlier, like driving my own passions and finding ways to match my lifestyle.
Nice. Dying on vine. Vineyard.
There you
Plant,
go.
we're playing that.
So,
Talking about it. Yeah.
so what was one deal that went completely left or right? Like whether it's successful, unsuccessful, what was something that was like a differentiated outcome that you expected, and what do you think caused that? What would you have done differently? Just like maybe give a lens into like some of the investment side of things.
Yeah, I mean, I remember we were about to get acquired by a company called Huddle, a sports streaming company, and I had that thing lined up, man. I mean, they were gonna hire my whole team, everyone was gonna make money, and I brought it to the board. And this is one thing that you'll learn later on, like, it becomes very complex. You're not really in control of your destiny. The more people you bring onto your cap table and things like that, you can, but it's very hard, especially, when we talked about earlier, like, you get $1 million in your bank account, right? And it's just like, okay, well, this is gonna sit here for like a year, right? Because you're not gonna just use all $1 million in the first month, right? And so you could, you'd probably run out pretty quickly, but and so I lost my train of thought. Oh yeah, so then we were gonna get acquired, and I thought, okay, this is perfect. It's what everybody wants, and I brought it to the board, and they were like, so they're gonna shut down half of the tech. I was like, yeah, who cares? You know what I mean? It's like, who cares, right? They're like, no, but like we believe in that, right? I'm like, I'm the founder, like I'm the one who should be able to say if I like care, like I built it, right? And they're like, no, like we want to see it go to the next level, right? So we're gonna match that deal plus 100,000. And I was like, that's the dumbest thing I've ever heard. Like it's just, you're like basically eating your own money. Like it didn't make any sense to me. And that's what they did. And so I was like, I'm not interested in running that company, right? Because they wanted to change the business model and do all these things. And so I stepped aside and I kept most of the ownership, but like it was just awkward, so that's one of the things that went completely sideways. And now granted that company's still running, it's profitable, it's it's doing fine, but would I have rather seen the exit? Probably, to be honest, because I don't like to wait, it's like if you have a bird in the hand, right? So that was kind of funny. So
Yeah, I mean, I think of the bottom 3 deals I've done thus far in my short venture career. I think lesson learned is never convince yourself to do a deal. Especially if something comes up at the last minute. A lot of times, like, deal fatigue is real. You just kind of want to get it done. If something comes up in the last week, it's probably for a good reason, and just don't do it. Because I'm sure some of you have heard, it's sort of like the 80-20 rule in venture and any type of investing is that your 20% of your worst companies take up 80% of your time. So you're going to all these extra meetings to try to turn the company around, all this stuff, and at best you're going to get a 1x out of the deal, probably not even that. So listen to that little voice and don't do the deal.
Absolutely. I think a lot of investors have this confirmation bias. It's inherent in us just being humans, where we convince ourselves why something is so special. But like what you really need to do to avoid confirmation bias is like tell yourself this is a horrible deal, and if you cannot come up with one reason why you shouldn't do it, then maybe you should. But there's probably a million reasons on why you should do it, but just kind of flipping the thesis on its head. So before we get into Q&A, because I'm sure you guys want to ask some questions as well, what do you guys each think that young founders should be working on right now? Is there a big problem? Is there kind of a sector? Is there something that you're interested in that excites you guys?
Well, I think cookie cutter answer, you should work on what you're most interested in, right? Because you have a unique set of skills, interests, talents, drive. If you're going to work on what someone else wants you to work on, you're not going to be the person to build that company. You're going to not be the cockroach or the camel or whatever to get the job done. But that being said, I think if you're wanting to build, a traditional venture-backed company that has a big exit, right? I mean, I think there's a few areas that I would, say you should go look at. One's the nearshoring trend in industrials, manufacturing, supply chain, etc. I mean, now with the Trump administration coming in, threatening tariffs, I mean, I think the next 4 to 10, 15 years or more, that trend's just going to continue. So if you have an interest in that space and you can figure out some way to apply AI or some other cutting technology into that space, cutting edge technology into that space, I think there's going to be winners there. I think another one is just energy transition with electrification and this renewed interest in nuclear, and then how that feeds into AI, and then the energy demands of a lot of the quantum computing hardware architectures. Like if you have expertise and you can find a solution set in that space, like there's going to be lots of big companies there too. And then finally, I think NVIDIA was mentioned earlier. NVIDIA was a super successful company as a gaming company, but they didn't become the most valuable company in the world until they basically created the AI market. So I think the lesson learned there is, I would say, look at trying to build something that if you're successful, it could create a market, because the biggest companies create the market and then they're kind of in charge of the market, for lack of a better term. And so those are kind of the 3 areas I point towards.
That's great advice. I think he's right. Like, don't look for where something is in the future, right? Like, no one can predict the future. I think being ready for things as they're coming towards you is more beneficial. So what I mean by that is build simply, right? And be kind of building in modular in a methodology so that you can adapt pretty quickly. Because a lot of founders that I talk to, they want to say, okay, in 5 years, in 10 years, in 15 years, and they have these like massive pro formas and all that kind of stuff. I'm like, what about the next 5 hours? Like, how many people are you going to call, right? Or like, can you think about the next 5 days? What are you actually tangibly going to do? What are you going to show me at the end of that 5 days? Because that's actually more important to me, because probably you're going to change your whole plan for next week. Like, that's just how it's going to go, right? And so with my company, we were in the right place at the right time, right? But we were building for 2 years before that happened, right? And so you kind of have to consistently be just kind of focused on not trying to solve, I think, the end-all, be-all, but there's something to be said about, selling the shovels to the people that are trying to go to the gold mine, or the gold rush, right? And being able to support an infrastructure. So, okay, yeah, everyone's interested in space, I'm interested in space, but am I going to try to be the next SpaceX? Probably not, but maybe I'm a hydrogen fueling station, right? And that makes more sense for the rockets, right? Or like I'm a modular space station, right? Like that can, take things into satellites, right? So I think that is kind of the advice that I would give, is just, start small, think about the first step in a 1,000-mile journey, because you're going to pivot, it's going to change, and I wouldn't even give any credit to like someone's model that's even past a year if they're in the first year of their business, just because it's probably going to be a different business. Same thing happened with the Groove Shark team, and like all the examples, they typically, like NVIDIA, they always have a story where it's like, oh well, they thought they were going to do this, and Aiden from Feather, his company was supposed to be a business card company, and then ended up being a really successful event management business that pivoted from that. So that's another local company here in Gainesville that was a success. So
They pivoted a lot.
yeah, pivoted a lot. Yeah.
Cool, so we'll get into some Q&A. Brandon will pass around a mic. So if you have a question, raise your hand. If not, I have some other questions.
No questions?
We don't bite.
Fine with that.
We're boring.
Yeah, that's okay. I saw 2 hands.
Yeah, go ahead.
Yeah, the question is, let's just say you're going to close, let's just say in the future you're going to close let's just say a multi-million-dollar business deal or something like that. How would you, advise that somebody close that kind of business deal? Like you're a company and you're selling somebody something and they want to have a multi-million-dollar budget to buy it from you. How would you close that kind of deal?
The first thing is to understand their needs, right? I've actually been fortunate to close several large deals like that. And you have to know all the different parties that are going to be involved in that decision from the beginning. So you're going to want to walk that process through pretty slowly to get them comfortable with that kind of purchase. Like for example, with Plug and Play, right? Plug and Play Orlando comes out of San Francisco. They have offices globally. When we sign up, a county or like Tavistock, which is Lake Nona, or even Duke Energy, those are massive 3-year, $1.5 million deals, and they have very specific goals, right? And so we need to be able to align our service offering with their goals, right? Because if we say, hey, look, this is what we can offer, and they're like, well, that's not even close to what we want, right? So it has to go the other way around. Like, find out what they want, find out who's going to be involved, find out what their end deliverables are going to be, and then make sure that you are matching that to that sale. And so I just want one more thing about, like, as a founder, like, you just need to sell. Like, you sell yourself, you're talking about to your team, you have to sell to your investors. You're at the bottom, right? Like, don't ever think that if you're the CEO or founder that you're at the top, that you're the leader. Everyone else is now dictating what you're doing, right? So, and it sucks, but it's true. And there's different sales cycles of that as a CEO, but your job is to shepherd everything and to gather resources and to be able to, be the manager of all of these people. But ultimately, like, they're going to dictate the way that the company's going to go. The customers primarily will do that for you. So,
I'll just add to that a little bit of a tangent, but maybe important to someone. We always want the big customer, the big contract, the big deal. But if you're a small startup, always be wary of having that one customer that's basically all your revenue, right? Because for an investor, that's a yellow flag, the next round. And then two, that, if you're in that position, that company could basically just like tell you what to do, right? Which is not necessarily the way you started the company. And that, I think that goes for if you're working at a smaller organization and you're contracting with a large, big customer. So just keep that in mind when there's sort of outsized contracts involved.
For giving the talk today. How do you see the local markets evolving? I want to say Florida has seen a massive increase in population as well as business talent and growth. I want to say the next 5-10 years, I almost can't say where we'd end up, but certainly Orlando, Tampa, Miami, West Palm. I think I don't know if I've heard anything out of North Florida, like Pensacola or Panama City, but certainly there's a lot of growth going on. Nano City and Kissimmee, Medical City in Lake Nona. And I want to say Lee County is now moving a lot of product, Amazon and whatnot are coming in. How do you see it evolving?
Yeah, Spencer's probably more qualified to answer, so I'll start since I have the mic passed to him. But I mean, I'll just say, I've only been back here living in the state for 4.5 months. I was up in DC for 15, 16 years. And I mean, it's crazy. There was not an innovation economy when I was in high school in 2005. There was the Air Force Base in Orlando, and there was Full Sail. And that was about it. There was the Space Coast. If the past is any predictor of the future, I mean, the next 15 years is going to be fantastic. And I'm excited to be back here, being a part of it, investing in great talent here, and helping build some of these companies. So I know I speak for all my deep work colleagues when I say that.
I'm uniquely very bullish on Central Florida because I'm from here, but I think the rest of the country is realizing the benefits of doing business here, of investing here. I've heard people call it the Silicon Swamp, so I'm not coining that phrase, but it definitely has nothing but upside, and so that's exciting. Like you said, from Tampa to the Space Coast, we have almost every vertical here, and we're very good at most of them, and we don't really tell our own story very well. And I think that's also a problem. We have, the universities, we have really the population, it's kind of spread out, but we have money here, and we have quality of life. And so those are the kind of things that companies look for when they relocate here. But one thing is that we are kind of a small mindset type of community, unfortunately, and so you'll see folks, like certain individuals that have bigger vision, and that's great, but it's not a collective vision yet. And so it's hard for them to even be successful in that type of environment. And so they're kind of pulling, I think, the rest of the people along, unfortunately, but that will catch up, I think, as more founders exit. Like Stacks in Orlando, they exited as a unicorn, and they're turning around and starting new companies and investing, in companies. And I was recently working with Pete.com, which is one of their spin-outs. So, it's really exciting to see, but it does have a long way to go. And I'll be the first one to say that, as bullish as I am on Central Florida. I think we need a decade of growth, and even if we do have that decade, I still think we're just catching up to New York, Boston, like, you know, and Denver even, and like, obviously Silicon Valley and Atlanta, they're all really far ahead of us. And so I'm very excited, you know, not to take anything away from everything that we've been building for the last 20 years, but we definitely have a lot of work to do, and I don't want people to just think it's just gonna come easy. As many VCs as there are here, we need 100 times that in companies, right? So it's important for the founders to really pull up their socks.
Okay.
Yeah.
You can grab the mic.
Spencer, TJ, thank you so much for taking the time to speak with us today. Spencer, I'm curious, you mentioned your anecdote about dealing with multiple stakeholders on a cap table, kind of putting yourself back in the shoes of an early stage founder, raising perhaps $100,000 at $1 million valuation. What are some favorable terms that you would look out for when dealing with new investors? And TJ, I'll open up the floor to you as well on that question.
I was like Aaron. I was very naive.
Favorable for who?
Yeah, it depends on which side, right? Yeah. So and he'll tell you some great terms. And I was very naive. You know, we were doing convertible notes, and we had a deal with an unnamed Shark Tank, host, and was part of our deal. And I negotiated that thing way down. My co-founder wanted to do the deal. I didn't want to do the deal. I knew it was a bad deal. But we ended up doing it because we didn't have anything to our name. I mean, we had no sales, right? And so I was like, this is better than nothing, right? It's upside. And granted, he did everything he said he was going to do in the contract, but it was a shark deal from day one. And it was 5 times worse when I first got that deal. So anyway, it ended up being the catalyst to me being in a room where I was able to pitch in front of some high net worth individuals as part of a mastermind. Walked out of that room with $800,000 in commitments to our first seed round. And so you never really know. I think that was a sentiment earlier about who you're going to meet, what you're going to. So you just have to be ready to always pitch. I mean, I was at TechCrunch in Silicon Valley, and they were like, "Oh, we're in San Francisco," and they said, "Hey, can you come up on stage in 1 minute and do your pitch?" And I said, "Sure." And they put my logo up on it, and I had to just ad hoc, pitch. And sure enough, someone came up after that. They invested $300,000 later. So I mean, it ends up having to be just put yourself out there, be bold, and be persistent, and you have everything at your fingertips. It's just how resourceful you are, right? And who you ask, and you have to ask. And I see a lot of founders just get in there and they'll have a great conversation with someone and they'll never ask for anything, right? And you're not going to get it, right? If you don't say, hey, can you introduce me to someone else, right? You're not interested, but can you introduce me to someone else? All right, yeah, I do have a friend who's interested in your vertical. Maybe, you could talk to them or I'll introduce you, and that could be the person, right? So it's about putting yourself out there, and so I think it's just important to. There's one more thing I wanted to say. What was the question again?
Terms?
Favorable terms?
Oh yeah, favorable terms, right? So I think going for the no is important on that. Like, so when you're talking to investors, you want to see where that limit is, right? And this is what sales do, but you want to, when you first haven't set your valuation, because you have a unique position when you first start your company where there is no valuation, right? And so if you can kick the can down the street as far as you can, that's important, right? So you don't want to necessarily price your round too soon, and what I mean by that is don't take an investment that's going to draw the line in the sand, that's going to say, okay, now your company is worth X, because then that's your benchmark and you have to build up from that. If you have a convertible note situation, you can kind of float your valuation to a price round. And so I think that's important, but definitely, look at I'll let you talk, but most favored nations and drag along clauses and all these things that they'll put in the deal.
Well, I'll briefly say 2 things. So, one, these relationships, you're building a business, right? So let's not overcomplicate a venture business, right? It's a business. You're entering agreements with people, partnerships, etc. So you want to like the person, right? I mean, if you're going to be talking to them for the next 5 to 10, maybe 15 years. $100,000 from this person might be way better than $100,000 from this person, even if this person's giving you a slightly cheaper valuation or whatever. So do business with people you like. Think of this as a marriage, right? All of you are thinking about do I get married in my 20s or 30s? You're super picky about your partner, etc. Be that picky about who you take capital from. To Spencer's earlier point about trying to get control of different situations. So that's one point, and then secondly, I think you know, I'm sure many of you heard this, but it's important not to get too hung up on valuation, right? So at the end of the day, you're selling a percentage of your company to investors, and even if it's valuation is not always what you think it is, right? Because investor might be giving you $20 million valuation, but in reality, they've structured other terms and so that it's really more like a $10 million valuation, right? But you don't realize that because you don't understand all the financial engineering that's gone on with the legal terms. So I think at the end of the day, don't get hung up on valuation. Go with your gut. Who are the people that are actually for you and want to help you build the business and have the relationships to help you do that? I think that's way more important than valuation.
Agreed. That was some really good advice. So, give it up for Spencer and TJ. We're gonna give them a